Hi candidate, welcome to another session of manifested earning classes. So in this session, I want us to look on an illustration question regarding the computation of diluted earnings per share. So this is our lesson number 4 of this particular topic. So in the first session, we defined what is earnings per share and basically the importance, the significance of the same. In the other session, that is lesson 2, we looked on the computation of basic earnings per share, and in our lesson number 3, we did an illustration question regarding the computation of earnings per share. And in this particular session, I want us to look on how do we compute the diluted earnings per per share. And specifically, I want us to look on a question which was tested in this sitting here. That is the sitting of April 2022. Specifically, this is question number 3C. So we read the question and it reads, A Limited, a publicly traded company, has 9 million ordinary shares of shillings 1 par value and 1 million 7% redeemable preference shares of shillings 10 par value each on 1st of October 2020. As at that date, A Limited had also in issue 2.5 million stock option. These options are exercisable at shillings 1.5 per share. The average fair value per ordinary share during the year which ended 30th September 2021 was 2 shillings. R Limited, profit for the year which ended 30th September 2021 from continuing operations was 14,575,000, and the profit for the year which ended 30th September 2020 was 15,100,000. So the following transactions took place during the year ended 30th September 2021. 1. On 1st January 2021, the company issued 1.8 million ordinary shares for in 1-for-5 right issue at a price of 2 when the market price per share on come right basis was 5. 2. On 1st April 2021, A Limited issued 1 million ordinary shares at full market value. 3. On 1st July 2021, the company issued shillings 5 million convertible bonds with effective interest rate of 12%. The bond is convertible into ordinary shares at the holder's option on the basis of 60 shares per 100 bonds. None of the bonds were converted during the year ended 30th September 2021. So number 4, the income tax rate applicable to A Limited is 30%. So what are we required? Number 1 is basic earnings per share for the year which ended 30th September 2021. Roman 2, restated earnings per share for the year which ended 30th September 2020. And Roman 3, we are required to compute the diluted earnings per share for the year which ended 30th September 2021. So we start with Roman 1, whereby we are required to compute the basic earnings per share for the year which ended 30th September 2021. BEPS for the year ended 30th September 2021. So the first thing we need to recall here is the formula for computing the basic earnings per share. And basic earnings per share is computed by taking the profit attributable to ordinary shareholders, abbreviated by PATOS. We divide that with WANOS, weighted average number of ordinary shares. So therefore, we need to compute these two items. So let's start by determining the PATOS. And we know that the PATOS, this one is equal to the profit after tax, or the profit for the year, and actually from the continuing operations. And then we less the preference dividends, we also less any profit attributable to NCI. So if you go back to the information we have in paragraph number 3 of that question, we are told A Limited profit for the year ended 30th September 2021 from the continuing operation was 14,575,000. It is important to note that in computing the diluted and also the basic earnings per share, the company should use the profit for the year from the continuing operations. So mean that any profit or loss from a discontinued operation should be excluded. Basically, a discontinued operation is a component of an entity which has been sold, like a subsidiary which has been sold, or maybe a branch which has been what? Closed down. So any profit or loss from such discontinued operation should not be taken into account in computing the basic earnings per share and also diluted earnings per share. So therefore, what you are given here is the profit for the year, the profit for the year, in which case we are told this exclude, or this is basically the profit for the year from the continuing operations, and that is given as a figure of 14,575,000. So to this, what do we need to do? We need to less preference dividends, and also we less profit attributable to NCI, in case this is or in case we are computing the profit or the basic earnings per share for a group of companies, we less the profit attributable to non-controlling interest. But basically in this case here, we are computing now the earnings per share for a single company, R Limited. This is not a parent company, so we don't have the profit attributable to NCI. What about the preference dividends? Are we given any information about the preference shares issued by this company? Yes, in first paragraph, where we are told this company had 9 million ordinary shares of shillings 1 par value, and also the company had issued 7% redeemable preference shares. There is something we said in our first lesson when we were looking on the introduction to the computation of basic earnings per share, whereby we said if the preference shares issued by the company are redeemable, one, we say that these are preference shares issued, the company is supposed to redeem them, to buy them back after a given period of time. To the company, we said this is a component of non-current liability, and equally we said the dividends which the company pay as far as these preference shares which are redeemable are concerned, those dividends are classified as part of finance cost. And basically we know finance cost, this is an expense. So in arriving at the profit for the year, this particular finance cost will have been deducted. So therefore, any preference dividends on preference shares which are redeemable, we don't less those particular dividends here because they have already been deducted in arriving at this particular profit as part of what? Finance cost. That is very, very important, and that's why you can see the examiner here had tricked you by giving you preference shares which are redeemable. Don't less their preference dividends here because they have already been deducted in arriving at that particular profit there as part of the finance cost. So mean that our PATOS here is therefore or remain the same amount of 14,575,000. So having that, we proceed and we determine the one-off weighted average number of ordinary shares. So how do we compute this? We compute this by taking into account the ordinary shares issued and fully paid at the start of the year, plus the other shares which were issued by the company during the current year. So we can see this year was ending on 30th of September 2021. It means that this year started on 1st of October 2020. So we need to determine how many ordinary shares were issued at the start of the year, 1st of October 2020. So, and we have that particular information in the first paragraph. First paragraph, and we are told this company at the start of the year had 9 million ordinary shares. So mean that the ordinary shares issued by the company at the start of the year were 9 million. In this case, we said you have to be very careful. Check whether the whatever you're given there, that is the value of the shares or the number. Anytime you don't have the word shillings before 9 million, it means that automatically the number of what? Of shares. And actually, you can see that is on 1st of October. So to this, what we need to do is we add the other shares which were issued by the company during the current year. So can we go to the where we have the transactions which occurred during the current year? So we go specifically to note number 1, and you are told on 1st January 2021, this company issued 1.5 million ordinary shares in 1-for-5 right issue at a price of 2 when the market price on the come right basis was 5. So what are we given there? This is a right issue. Remember, you say these are a very common concept. Anytime you come across a question for a right issue, mostly this concept is tested. So, sorry, anytime you come across a question for earnings per share, this concept is always tested. So, we are told on this date there was a right issue. There was a right issue. So what we said is that during a right issue, the company issues shares to the existing shareholders of the company at a price below the market price. So what we do is that the shares issued, we have to split them into two. Shares issued at full market price and the shares issued free of charge. But for us to do that, we need to compute two items. One, how many shares were issued by the company during the right issue? In our case, we are already given the shares which were issued, which we are told they were 1.8. That is already given to us. So the other thing we need to compute is something called the theoretical ex-right price. Theoretical ex-right what? Price. Basically, this is the market price per what? Per share after the right issue. And basically, in terms of how we compute this, is basically very, very simple. We said here, we say that before the right issue, if a shareholder held 5 shares, because we are told during the right issue, the company made a right issue of 1 for 5 shares. It means that 1 for 5. It means that during the right issue, the company was to issue 1 share for every 5 shares which were held. So if therefore before the right issue you held 5 shares, and each share before the right issue was trading at 5, then during the right issue, as a shareholder of this company, during the right issue, you are to be issued with one share, but at a price of what? At a price of 2. At a price of 2. At a price of 2. And I think having that, we can proceed. We determine the theoretical ex-right price. So we take this plus times that, which will give us 25, this times this, which will give us 2. And basically that means that a shareholder who held 5 shares before, after the right issue, he'll be holding 6 shares. And the total market price of those 6 shares is what? Is 27. So what will be the market price of 1 share after the right issue? So we take 27, which is the price of 6 shares, divide that with what? With 6. So this will give us now the market price of 1 share after the right issue. 27 divided by 6, and this will give us 4.5. 4.5. So that is the theoretical ex-right price. So having that, let's come back here. We do our split. We start by determining the issue at full market price, which is equal to amount received by the company from the right issue, which is equal to the shares issued 1.8 times the issue price. The shares were to be issued at a price of 2 shillings per share. Then divide that with theoretical ex-right price 4.5. And then these particular shares should always be weighted on time basis. Should always be weighted on time basis. On time basis for the period they were held. So these shares were held from 1st of January 2021, and we know the year was ending 30th September 2021. So these shares were held for 9 months, 9 all over 12. Then from there we determined the bonus shares. The shares issued free of charge, which is equal to the total shares which were issued, 1.8 minus the shares issued at full market price. What we have here, not the final answer you get here, but these are the shares issued at full market price. 1.8 times 2 all over 4.5. And these particular shares here, we said they should not be weighted on time basis. So let's determine the shares issued at full market price, which will give us 600,000. And then we determine here the bonus element, which will give us 800,000. We less that from 800, 1.8, and this will give us 1.1 million. So 1 million, these are the shares which were issued free of charge. So that's how we deal with the concept of the right what issue. So let's move to point number 2, and you're told on 1st of April 2021, the company issued 1 million ordinary shares at full market price. So on 1st of April 2021, we say there was issue at a full market price. So how many shares were issued? 1 million. 1 million. So what we just need to do, to these shares issued at full market price. We weigh them on time basis for the period they were held. We multiply them with the proportion of time they were held. They were held from April of 21st April 2021 to 30th September 2021. Automatically, those are 6 months. So we have April, May, June, July, August, September. So those are 6 months. So we multiply that with 6 all over 12, and basically that will give us half, which is 500,000. So that's what we have. And then in note number 3, we are given information about convertible bonds which were issued by the company, which were issued on 1st July 2021. And in the last sentence, we are told none of the bonds were converted during the year. So remember, we consider such convertible securities in computing one-offs if some of them were converted into ordinary shares during the current year. So therefore, these will not be applied here. We are not going to use that here, but that will be used in computing what? The diluted earnings per share. What you're given in note number 4 is about the income tax rate. So basically what that means that we don't have other shares which were issued during the current financial year. So what we need to do, let's add all this. So we have 9 million plus 600,000 plus 1 million plus 500,000. So which will give us 11 million 100,000. Yes, having that, what do we need to do finally? We need to compute now. Remember, this is our weighted average number of ordinary shares. So we need to compute now the basic earnings per share, because we have the 2 items we require. So we have the PATOS there, and then we also have the one-offs there. So the basic earnings per share is equal to PATOS 14,575,000. Divide that with the one-offs, which is 11,100,000, and we get the final answer, which is 14,575. Divide that with answer, which will give us shillings 1.313 shillings per share. So that is it. That is what was required as far as Roman 1 of that question is concerned. So let's move to Roman 2. In Roman 2, we are required to compute the restated earnings per share of the year which ended 30th of September 2020. 2020 is basically the previous year. So this is, in other terms, what we refer as adjusted earnings per share. And the earnings per share of a previous year is adjusted if during the current year, the current year we can say is the year 2021. If during the current year, there were some shares which were issued as bonus shares or free of charge. So, and therefore, in terms of how we compute this restated earnings per share, we take the PATOS for this year, which is 2020, divide that with the one-offs for 2020, and then now to the one-offs, what do? You add the bonus shares, which were issued in the preceding year, the year 2021. So in our case, we already have the PATOS in in paragraph number 3, where we have the profit for the year 2020, which is 15.1. Remember, the profit for the year, just like what we have said in this year, the profit for the year, or the profit after tax, is the same with what? With the PATOS, because we don't have preference dividends. So therefore, the PATOS for that year, 15.1 million, 0.1, divided that with one-offs for the previous year. As far as the previous year is concerned, 2020, we only know the shares which were issued and fully paid at the end of 2020, which were the same with the shares issued and fully paid at the start of the current year. And therefore, if we are just given the shares issued and fully paid at the end of the year by the examiner has not given you the shares which were issued during that year, then you assume those were the shares which were outstanding for the whole year, and therefore that will be your one-offs. So therefore, the one-offs for 2020 will be 9 million. And then now to this, we add the bonus shares which were issued during the current year. So during the current year, do we have bonus shares? Yes, we have this 1 million bonus shares, 1 million. So therefore that will be 15.1, or basically 15 million divided by 10 million, So this will be 15,100 divided by 10 million. That will go. So this will be shillings 1.51 shillings per share. So this is the restated earnings per share for the year 2020. So then from there we proceed to Roman 3, and I hope you can see the marks which were allocated in that particular question. There were 2 marks. Generally, what is marked in such a case are those items. By doing that, you get 2 marks. In Roman 1, what was the marks allocated there? 4. So what is marked there is the PATOS, profits attributable to ordinary shareholders. And basically, were you able to deal with these different types of shares which were issued during the current year? So by doing that, you get now the 4 marks which were allocated there. So let's move to Roman 3, whereby the examiner was requiring the candidate to compute the diluted earnings per share, DEPS, diluted earnings per share for the year which ended 30th of September 2021. So in computing these diluted earnings per share, basically here you need to follow like 3 steps, 3 simple steps. The first thing, one, you go through the information which you are given there, and you identify the potential ordinary shares the company had during that year. Potential ordinary shares here, you'll be looking for things like convertible securities. Which convertible security had the company issued? And 2, you check, had the company, or whether this company had granted the employee stock options which are to be exercised in the future. That is the first thing. Identify the potential ordinary shares of the company in the year under consideration. Once you do that, step 2 is you compute increase in earnings, increase in number of shares for each potential ordinary shares. And for you to do that, you have to assume that those particular convertible preference shares or those particular potential ordinary shares were converted into ordinary shares. And actually, in our previous session, we looked on how we determine the increase in earnings, the increase in number of shares for different types of potential ordinary shares. That is something you have to recall. And then once you do that, step 3 is you compute the diluted earnings per share. I gave you the formula for that equal in the previous session. So those are the 3 simple basic steps you need to follow in computing the diluted earnings per share. So therefore, what we need to do first of all is we go back to the information which is provided here, and we check which potential ordinary shares this company had, or the potential ordinary shares, or potential ordinary share or shares of R Limited in the year 2021. I've said here you check for convertible securities which the company may have issued, and stock options which may have been granted to the employees and which are to be exercised in the future. Now, number 1, from the information we have in paragraph 2, we are told this company had granted the employee stock options. And take into account these stock options are to be exercised in the future, they automatically qualify to be potential ordinary shares. Also, if you go back to the information, or you go to the information given in note number 3, so we are told this company also issued convertible, that is 12% convertible bonds. 12% convertible bonds. So therefore, in our case, these are the two potential ordinary shares which R Limited had in the year 2021. Having done that, we go to step 2. We compute the increase in earnings, increase in number of ordinary shares, or increase in number of shares for each, on the assumption that these potential ordinary shares were converted into ordinary shares during the current year. So let's start with the stock options. And now you have to recall what we discussed in our previous session as far as the computation of increase in earnings and increase in number of shares is concerned. We said increase in earnings for stock options always is zero. As a result of the employees of the company exercising their stock option during the current year, that do not result to any form of savings by the company. There is no savings the company will make. So the increase in earnings is equal to zero. So what about the increase in number of shares? Increase in number of shares, we said that this is equal to the bonus element. What we consider here are the shares which would have been issued to the employees of this company free of charge. You have to recall the formula. How do we compute these bonus shares? You take the total shares which would have been issued to the employees, assuming they exercise the stock option during the current year, and then to this deduct the issue at full market price. So how many shares would have been issued to them at full market price? So as per the information given in paragraph 2, we are told, as at that date, that is now at the start of the year, this company had granted the employees 2.5 million stock options. So basically what that means, and basically option is a right, a stock option is a right. And actually, unless told otherwise, you assume one stock option is equivalent to one share. So mean that if the employees exercise the stock option during the current year, then they would have been issued with 2.5 million shares, and then we deduct the shares which would have been issued to them at full market price. So in terms of how we compute these shares issued to the employees at full market price, one, you compute the amount which would have been received from the employees, assuming the employees exercise the stock option during the current year, and then divide that with the average market price. Average market price. So how do we compute the amount which would have been received from the employees? We take the shares which would have been issued to them. Remember, we are making an assumption here that the employees exercise the stock option during the current year. So they would have paid an amount of 2.5 times the amount they were to pay per share. The amount they were to pay per share was 1.5, and then divide that with the average market price per share, which is the same with the average fair value, which is 2. So this will give us now the shares which would have been issued to the employees of the company free of charge. So let's work out on that. We compute that. So what do we have here? We have 2.5 times 1.5 divided by 2, and then we deduct that from 2,500, which will give us 625,000 shares. So in our case, basically what that means that we already have now the increase in earnings and also the increase in number of shares. So we need to proceed and deal with the other type or deal with the other potential ordinary share, and that is 12% convertible boats, where we need to compute the increase in earnings and also the increase in number of shares. So we have 12% convertible boats. Convertible boats. So we start by computing the increase in earnings. And the increase in earnings, as far as the boats are concerned, in our previous class, we said that this is equal to the interest which was paid by the company, interest paid, but we multiply that with 1 minus tax rate. 1 minus a tax rate. So let's compute the interest which was paid here. Interest which was paid, which will be equal to 12% of the value of 12% convertible bonds, which is 5 million. 5 million. But it's also important to note when these boats were issued. The boats were issued from 1st of July 2021, and basically the year is ending 30th September 2021. So the company here paid interest not for the whole year, but from the date the boats were issued. So they were held for how many months? Or basically the company paid interest for July, August, September. The company didn't pay interest for the whole year. So multiply that with 3 all over 12. That will give us the interest paid. and then multiply that with 1 minus tax rate. Tax rate as per note 4 is 30%, so this is 1 minus 0.3, which will give us 0.7. So this will give us now the interest which was paid by the company, but net of a tax, net of tax. So let me compute that here, which is 12% times 5 million times 0.7, which will give us for 20,000. For 20,000. So then finally, as far as this is concerned, we need to compute the increase in number of shares. So increase in number of shares, basically this refers to the number of ordinary shares which the company would have issued on the assumption that these both were converted into ordinary shares during the current year. So what we need is a conversion rate. The conversion rate is given in note number 3, sentence number 2, where we are told the boat is convertible into ordinary shares at the holder's option on the basis of 60 shares per shillings 1,000 boats, per shillings 100 boats, not 1,000, 100 what? Boats. And in our case, we know the boats which were issued by this company, they had a value of 5 million. 5 million. So what we need to do is basically to determine the number of ordinary shares which would have been issued by the company on the assumption that this particular boats were converted into ordinary shares during the current year. So we take 60 times 5 million, divided that with 100, It's also important to note the date when these boats were issued. The boats were issued 3 months to the end of the year. So basically what that means is that even if the holder of these boats converted them into ordinary shares, they could have converted them from the date of the issue, from 1st July 2021, meaning that these particular shares which could have been issued to them would not be held for the whole year, would only have been held for 3 months out of 12. So we have to weigh those particular shares equally on time what basis. So let's work out that. And we see the number of ordinary shares which would have been issued on conversion. We have 60 times 5 million divided by 100 times 3 divided by 12. So which will give us 750,000 shares. 750,000 shares. So that refers now to the number of ordinary shares which would have been issued, assuming that those particular boats were converted into ordinary shares. And what is important as far as this particular question for computing the diluted earnings per share are concerned is computing these items: increase in earnings, increase in number of shares for the various potential ordinary shares. So those are the items which give you marks. So having that, finally what we need to do is we compute the diluted earnings per share, which is equal to the PATOS, profit attributable to ordinary shareholders. We already have that here, 14,575,000. We divide that with WANOS, 11,100,000. To the PATOS, we add increase in earnings for all potential ordinary shares. So the increase in earnings there is 0. Increase in earnings there is 420. So come, you add them here. You add that here, even if it is 0, make sure you include it here. So you have 0 for stock option and for 20 for convertible bonds. And then to the WANOS, you add increase in number of what? In number of shares. So the number of shares there 625. Here is what? 750. So you have 625,000. And this one, which is 7 what? 50. So we work out all that, and basically that should give us now the diluted earnings per share. Diluted earnings per share. So let's work out that. We see what we are going to get here. So we have 14,575 plus 0 plus 420. Okay, 420, divide that with 11,100,000 plus 625,000 plus 750. Yes, and that will give us shillings 1.2020. 2020. Yes, so basically that is it, that what was required there. And you can see that the marks which were allocated there were 4. Mostly what is marked are these items. These are the items which will give you a candidate now there. The 4 allocated what? The 4 allocated marks. So that's basically what was required as far as that question is concerned. Before we wind up, I want to give an assignment. As far as this computation of diluted earnings per share and also the computation of basic earnings per share is concerned. We have so many questions from the past papers, but specifically I want to give this question here to be your assignment. So and this is the question for May 2019, question 4B. Question 4B, make sure you attempt that particular question, but I'm saying we have so many questions from what? From the past paper. So once you attempt that particular question, if you have a challenge, I usually encourage my candidates, my students, to acquire this particular revision partner from Manifested Publishers. It is updated up to the latest sitting. You'll be able to get the solution for all those particular questions at the back of this particular book. So make sure you have this because it will help you in course of your revision. So basically that brings us now to the end of that particular topic of the earnings per share. And actually from the past papers you can see this is a very, very important topic for you to be able to understand because it's highly examinable. So see you in the next session as we look on the other topic.